Okay, so now what capital budgeting means is this, like capital budgeting generally represents planned investment in fixed assets over a period of time. So how you are going to actually use your money for the fixed assets, not necessarily all the time it will have to be fixed asset. Okay, it can be it can be used, the money can be used for new project too, for extension of the business as well. Okay, it could be a new project, it could be extension of the existing business, it could be setting up a new business under the same entity, it could be fixed assets. So the whole point is like when the business will have some shortage of capital, how they are going to actually collect the money and how they're using this money in a project. For example, let's say even not necessarily it will have to be collected the money. It could be like this way that, well, you have some money, your business have some money, how they're going to utilize this money and how they're going to use this money for capital purposes. Okay, that's the whole point we discuss here. So capital budgeting refers to the process of developing and analyzing investment projects and deciding which ones should be included in the capital budget. So you might have a couple of projects. So you have to decide which one you are going to actually take, which one you're going to select to do this capital budgeting. So this analysis involves an examination of relevant cash flow. So how do we do that? We do that using cash flow. So how much cash inflow and how much cash outflow is involved in here. Okay. So this says here, the practical budgeting is similar to security valuation as well. How do you value the security? Here also you can actually value the project, different project you will have, which project you want to take. So maybe you will have an offer of 2-3 projects you have in your hand. So which one you are going to actually go ahead? Okay, so they say there are 4 basic distinctions are made when categorizing investment project. So 4 things we have to discuss here. They say first one is here the time to talk about, okay, normally what we do is that we actually, at the beginning of a project, we call it year 0, time 0. At time 0, we are actually making our investment, which is called cash outflow. How do I mean? Let me actually draw these things in a new share, whiteboard. For example, in here, so you have some project, and let's say this is year 1. Okay, this is year 2, year 3, year 4. Let's have some years here. 5. Let's say this is 5, year 5. Okay. All right. Okay, year 5. This 5-year project you have, and this one is actually year 0 that we always talk about. This is your year 0. So this is year 0. Okay, this is year 1, year 2, year 3, year 4, year 5. So here, year 5. It's a 5-year project you have. So year 0, what you do, you make an investment. Okay, first year you're making investment. So let's say in here your investment is, let's say, $7 million, for example. You started $7 million. And this one, this $7 million will be your negative project. This $7 million is your negative. Why negative? Negative because money is going out of you. You're investing the money. So this is your cash outflow. Money is going out of the entity for a project, minus. Then year 1, for example, in here, you will receive some money. Year 1, oh no. Year 1, let's say you are receiving, let's say, 1 million. Year 2, you are receiving, for example, here you are receiving 2 million. Year 3, you are receiving, let's say, 1 million. Year 4, again, you're receiving 1 million. And yet here, it's receiving again, let's say, 3 million. So you can see here, 3, 4, 5, 6, 7, $8 million you're getting in 5 years' time. Okay. Now, the thing is this, that look, at the first year, you're making the money, in making investment, other years are getting the money. This is cash inflow. First year is cash outflow. This is called conventional process, conventional approach. It says here. So this is called conventional one. This is conventional cash flowing. But a non-conventional one is different. Non-conventional one, so this is very simple, pretty much you guys understand these things, okay? And non-conventional one means like this. Non-conventional one means that, okay, that not necessarily all the time it will be first year you're making investment, other years you're receiving the money. It may not the process all the time. It might happen that at year 4, your business needs some, the business or fixed asset or project needs some more money. Okay. At that case, let's say here again, you will have minus, let's say, 1 million again. Let's say 2 million again. Like for example, this is the case. And let's do this one, may not look very positive. So these are, let's 4 million, for example. Okay. So now look at here that the situation is this, like on 4th year, you need to invest another 2 million. Why? If it is a fixed asset, for example, your asset needs some repair. Asset needs some maintenance expenses. Asset need more insurance to be involved. So it depends on actually what type of project it is. Maybe on 4th year, you need more money to capitalize the existing project as well. So if that is the case, then this is called non-conventional. Non-conventional doesn't mean that first year is the only year to get the money out. Not necessarily. First year may not be the only year for your cash outflow. It may not be. It might be like in between the other years, too, later, maybe you also have to pay some money. Okay. So let's go back. So this is project displaying a conventional cash flow pattern of an initial net cash outflow, initial investment, with subsequent relevant cash flows, all being net cash inflows. Okay. And non-conventional cash flows, non-conventional one, let's say this one. So I did not want actually number 2 in here, not 2. Okay. The non-conventional cash flow pattern is characterized as one of the net cash outflows after the initial outflows. It might happen that one or more cash outflows, not necessarily all the time it will be the first. It could be more than one time you are actually have to make cash outflows, make investment. That's non-conventional one. Okay, that's the difference they're trying to say here. Okay. Second point they're discussing here, the relevant cash net flows from a project subsequent to the initial investment may take the form of either an annuity. So now if I take you back, I will not take you back, but I want to remind you that it might happen that every year is same income. Every year is same. This is called annuity. If it is every year is same, this is called annuity. If it is not every year is same, actually I should take you there. I'll take you there. Okay, so look at here. Our every year is actually not same. First year 1, 2, 4, 1, 3. So it's not, every year is not the same cash inflow. It might be every year will be same. If it is every year is same, this is annuity. If every year is not same, we call it mixed. Look, 1, 2, it mixed. Okay. So there is no guarantee that every year will have the same amount of return. No, not necessarily. Okay, let's move on. So yeah, so they say the relevant net cash outflows from a project subsequent to the initial investment may take the form of either an annuity, equal amounts at regular interval, or a mixed stream. When they talk about mixed stream, it means that it may not be the same every year. Okay. Third topic is this, third point is this: investment projects can either represent an expansion of farm, I already told you, expansion of the farm activity, or replacement of existing asset, or buying a new asset, or taking a new project. It depends. It could be various, not necessarily all the time. It will be just the fixed asset. No, not necessarily. Okay. The fourth point is saying that a group of possible investment projects may either be independent or mutually exclusive. So now the question comes up, like I told you, that there could be more than one project in your hand. So if it is the case, or maybe you have a couple of options in your hand, like you want to replace a machine. So you have 2-3 options. Okay. So now, if it happens that a couple of options are related to each other, we call that not mutually exclusive. When this says mutually exclusive, it means that none of the options are related to each other. They're individual. Okay, they are individually independent. So it means that your projects one project does not have any impact on another project. That is called mutually exclusive. So at that situation, you have mutually exclusive project, then you can choose more than one project. You can invest in more than one project. If the projects are mutually exclusive, only one of them can be undertaken. So if it is mutually one, all of them have no connection to each other, you take anyone, you can take more than one even, doesn't matter. But if they're mutually exclusive, it means that if project is mutually exclusive, only one of them can be undertaken. Okay? If the project is independent, the decision to invest in one of them does not rule out consideration of another one. Okay, so it depends on if they are not connected to each other, take more than one. If they're connected to each other, take only one. That's it. So yes. Project may be mutually exclusive because of financing constraint. There may be only one financing available for one project. Operational considerations. There could be several competing designs too. In reality, farms normally face a situation of capital rationing in which the total financing available for new project is restricted. In that case, a choice may need to be made among independent projects that are deemed acceptable according to the capital budgeting techniques. This choice is made with reference to the ranking procedures. Okay, so they have to find out which one you have to take. So you make a ranking. First priority, second priority, third priority, like this. Make a ranking in there. All right, now the second point we're going to talk about is determining the project. So first here we have given you some conditions, some situations, okay? So 4 of these points you discussed in the distinctive features in there. 4 basic distinctions are made when categorizing investment project, which project you're going to pick up. And now we're going to talk about this second part, determining a project relevant cash flows. How do you determine the relevant cash flow? The relevant cash flows for a project are incremental after tax flow, after tax cash flows. So this says here, the relevant cash flows for a project are incremental after tax cash flows. So it will be incremental after tax. So it will show you that how much cash flow is increasing. It will show you there because of the project. How do you calculate that? We're going to actually do some one example, and you will see that how do they calculate it. Okay, they say that the procedures is this. First, you calculate initial investment, then you calculate annual operating net cash flows during the life of the project, then you calculate terminal cash flows. So there are 3 steps you have to follow. First step is the initial investment. Second step is calculate annual operating net cash flows during the life of the project, and finally the terminal cash flows. Okay. All right. After tax means after paying the company tax, they mean here. Okay. And here, okay, this says here another one, relevant project incremental after tax cash flows shows you that you will be actually comparing if you take the project, what your cash flow will be. If you do not take the project, what will be cash flow will be. So then you compare these two. Like for example, in here, so you have project implemented, so you take the project. You have accepted the project. So how much you cash inflow. Then if you do not take the project not implemented, then how much is your cash inflow. So these two needs to be compared. And what they compare, they're comparing, they find that this is the increment in the cash flows. Okay. So if you take a project, take the project, or then it says here sales will be 12,000. But if you do not take the project, it means currently you did not take the project, 9,000. Now you're considering to take a project. If you take the project, definitely you are actually, okay, it will be increasing. Why? Well, nobody is actually expecting or taking in a project that does not add some value to the business. Definitely there will be actually some more income will be in there. So sales is 12,000 if you take the project. Cash operating cost, well, the project will have some more expense as well than existing one. Now currently your expense is 4,000, but if you take the project, it will become 5,000. And bracket means negative, you know these things. Then depreciation, current depreciation is $1,000, but if you take the project in, it will be $2,000. Okay. Then they talk about the pre-tax income is $5,000. Your pre-tax income is $5,000, and what they're saying here, and your tax is 30% is the tax. So tax is $1,500 in here. Okay. So same thing is coming up here. So 9,000 minus 4,000 minus 1,000, 4,000 in here. 30% is your tax, 1,200. So net operating income is 35. If you do not take the project, it will be 2,800. So here they're showing you the gap, the difference between these two, taking the project or not taking the project, the difference is in here. Okay. Yes. So that's the $700 is your total. Now, the last line, that's interesting part is in the last line. Here this says operating cash flow. How do you calculate operating cash flow? This is the formula. The formula says cash flow will be equal to net operating income plus depreciation. Look at here. Net operating income 3,500 plus depreciation. So it will be 5,500. That's the formula. And here it will be 2,800 plus 1,000, 3,800. Okay. Now the gap between these two operating cash flow is 1,700. That's incremental operating cash flows. Okay. This does the relevant incremental net cash flow for the project for this year shown as 1,700. That's how they calculated this year. Okay. All right. Now there's an example in here. So we have to actually go through this example. It will be this is a good example, and we will go through these things. So this says a detailed example involving replacement project. So they have a project here that needs to be, this is a replacement project. So you are going to replace one of your assets. They say, suppose an earth moving company is considering replacing an existing bulldozer with a new machine that will enable the farm to do more jobs. Okay. Now the following information is given. What information is given here? This says the information is the new machine would have an expected work life of 4 years. So new machine has a lifetime of how much? 4 years lifetime. And the existing machine is also expected to remain usable for another 4 years. Existing machine will be also, you can use it for 4 years too. All right. The company pays tax at a rate of 40%. So Australian tax rate is 30%. But this is, I believe, this is an American book. So they have actually US book, and this one is actually 40% tax that they are using it. And it uses the prime cost method for depreciation. The prime cost method is straight line method, we call that. Okay, every year we'll have the same amount, same number, same amount of depreciation. That's a straight line method, or the prime cost method. Both the new and old builders. So they have 40% tax rate. They're using prime cost method or the straight line method, and for both the machine. The cost of new bulldozer is $50,000, and there are no installation costs. So there is no other extra cost involved in here. The depreciation of the old bulldozer, depreciation of the old bulldozer is $5,000 per annum, and it will be fully depreciated in 2 years' time. Okay. The old bulldozer Old bulldozer, it will be $5,000 every year. And for how long? For next 2 years. The salvage values of the bulldozers in 4 years' time are 5,000 for the new machine and 2,000 for the old machine. But they say the salvage values of the bulldozers in 4 years' time are 5,000. So salvage value means, what is salvage value? After its lifetime, when you sell this off, when you're selling it off, how much you can get. Okay, so new machine you will get for $5,000. If you, after 4 years, when you finish your work and you wanna get rid of the machine or dispose the machine, you will get $5,000. But for the old machine, after 4 years, you can get $8,000. The old machine can be sold now for now if you sell this machine, okay, now if you sell the old machine, $8,000 you can get, and you bring the new machine in, okay? The use of the new bulldozer will require an increase in net working capital of 5,000. So they said if you bring the new bulldozer, okay, it will require $3,000 of, it require an increase in net working capital, $3,000 of working capital needs to be increased. If the bulldozer is kept, annual profit before depreciation and taxes will be 30,000. If you maintain the old bulldozer, then you will get $30,000. While with the replacement bulldozer, annual profit before depreciation and tax will be $45,000. So the following table summarizes the calculation. Here is the calculations. What did we say? 3 steps. Remember 3 steps? These 3 steps we're going to do now. Initial investment, annual operating net cash flows during the lifetime of the life of the project, and the terminal cash flows. So 3 steps. Now let's go in. Okay. Determining the initial investment. Okay. Cost of new machine, 50,000. Oh, look, all these figures are in thousands. Okay, so when you see this 50, don't get upset. This 50,000. I mean, okay. They say determining the initial investment. It says is $50,000. Cost of new machine. No installation cost. Proceeds from sale of old asset. Since you are actually buying a new machine, new bulldozer, you're gonna actually sell the old one. How much you get from the old one? 8,000. Okay. And you will be saving a tax saving on sale of old asset will be 0.10%. Changes in net working capital, you will have to spend more $3,000. This is here, you can see here, $3,000. This is the use of new bulldozer recurrent increase of the net working capital, $3,000. When you bring the new machine, it will need more money to be there, maybe for maintenance, maybe for other things, yes. Keep it running, or maybe you have to bring up for new bulldozer, maybe new employee to run it, maybe something experienced. Okay. But I don't know which reason, but some purpose it will need, you need maintain a $3,000 of net capital. Okay. Now, this is step 1, determine the initial investment. So 50,000 is a negative. This is the savings you have. So the initial investment will be minus 44.2. That's the initial investment if you want to. If you want to buy the new bulldozer, okay, 44.2. Operating cash flows, yeah, with new assets, with old assets. Okay. All right. This is here. Profit before depreciation and tax. If you have the new machine, this says here, you can see here, $45,000. So for the replacement bulldozer, annual profit before depreciation will be $45,000. But for the old one, it will be $30,000. Okay, 30,000 here is 45,000. Okay, so that's what they did here. So for the new machine, your profit before depreciation and tax is 45,000 every year, and profit before without the and with the old machine it will be 30,000 every year. Then how much is depreciation? This depreciation will be actually 12.5. How did they calculate it? They calculated here this way. The new machine would have an expected working life of 4 years, and they're using depreciation of student method depreciation. So how much they spent? $50,000 to buy the machine. 50,000 divided by 4 years, it will be 12.5 every year. 12.5, 12.5, 12.5, 12.5. That's the depreciation. Then you can see here another one they're talking in here is for the old machine. They say the depreciation will be, depreciation for the old bulldozer is 5,000 per annum, and it will be fully depreciated in 2 years' time. Okay, will be depreciated in 2 years' time. So depreciation $5,000 for 2 years, then other 2 years there will be nothing to depreciate because it's fully depreciated. Then you can use this machine without depreciation. Now net profit before tax, so 45 minus 12.5, and here 30 minus 5, so it will be 25, but this year is no depreciation, remains 30, remains the same, intact. And for this case here, 12.5 every year, 12.5, 12.5, 12.5, and this 12.5. So it will be 32.5 for 4 years. Now the question comes, net profit after tax 19.5, how did they calculate this one? 19.5, they calculated this one by this, look at here. So calculator. So it was 32.5 before tax. So it's 32.5. And this says tax is 40%, right? So 32.5 minus how much? 40%. 40%, how do you calculate 40%? What are the brackets? Oh. 32.5 minus 40% of this one, right? So first bracket, 32.5 multiplied by 0.40, 40%, bracket close, equal to 19.5. That's how they calculate it. Another way to calculate this one, I can show you this.
Do you have formula for this?
Sorry?
We have formula for this, the net.
This to calculate, this is common sense. Like I tell you this, let's say you have $100. Now if you pay the tax, 30% tax, how much is left with you? 70, right? How do you calculate it? You can do this way. Like let's say $200, 30% tax. How much is left with you? For 30% tax, if you pay 30% tax, it means 70% will be kept with you. In this case, 40% is the tax. It means 60% you will be keeping with you. So in that situation, if I go here, like let's say 32.5 multiplied by 60%, 19.5. That's how they calculate it. So since 40% is your tax, it means 60% will be left with you. So 32.5, where is 32.5? 32.5 is your net profit before tax. Now it's time to pay the tax. How much is tax? Tax here is 40%. Right? Here is 40%. Tax at a rate of 40% tax rate. Okay, so 40% tax rate in here. Yes. Okay, so yes. All right, anything else in there? So that's it. This is the case in here. So 32.5 minus 19.5, you get 32.5%. Okay. And for this, if you do not have the new, bulldozer, if you continue with the old bulldozer, that time it will be 12, 12, and this year 14. Now, how did they calculate this 32 in here? That's interesting point. This 32 they calculated this way. I'm showing you 19.5 income, net profit after tax plus 12.5 depreciation. How I know these things? Here is the formula. Net operating income plus depreciation. That's why they got 32. This 32 thing I mentioned. But if you, these things I mentioned in here, okay, I calculate, but if you have the file download, it's not there. It's not there. So I have actually calculated in here, showed here, how did they get this $32 in here. Okay. All right. Hmm. Okay. In here, the same case in here. So here it says operating cash inflow 20. How did they get 20? Net profit after tax 15. Okay. Net profit after tax is 15. And they have here 15 plus depreciation is 5. So 15 plus 5, 20. 15 plus 5, 20. So this one. Okay. And here 18 plus 0, 18. 18 plus 0, 18. Now the question comes up. Now we have to calculate about incremental operating cash flow. How much incremental then? How much increase? What did we do? We said here, if you notice in here, if you take the project, if you do not take the project, 2 items. Okay. So they did in here. Look at this one. So operating cash flow 32, and here operating cash flow is 20. 32 minus 20, 12. Okay. 32 minus 20 is 12. Hmm. All right. Okay. What else we got? Yeah. Last one is determining the terminal cash flow. What is terminal cash flow mean? Terminal cash flow means this way, that end the fourth year, last year, I'll show you, take you guys to this point. Not this. Like year 5 is your, and for a project, year 5 is your last year project, okay? What this says is this. When you finish up the project, what are you gonna do? You're gonna sell off all the item, or you're gonna, whatever you do. So terminal year means the last year. And last year, you're terminating your project, it's called terminal year. Okay? So in that case, let me go back. Terminal year, in the fourth year, you have to check on what is your cash flows on fourth year. Okay, determining terminal cash flow means last year's cash flow here. Last year, what this says here, look at the last year, they said you're gonna sell this asset. Okay, they said the old machine can be sold for 8,000. Okay, the use of new bulldozer will require increases. So this is the thing I need. The old machine can be sold now for 8,000, and they said the new machine, they can sell new machine too. There is one point they say. Oh, here. The salvage value for the bulldozer in 4 years' time is 5,000 salvage value. So this one is for the new machine. So new machine salvage value is 4,000. It means after 4 years, when you finish off your work, you are actually selling the new machine that you purchased. Okay. And this says, and $2,000 for the old machine. For old machine, you will be actually selling it for $2,000. So if you go back now, so yeah, proceed from sale of new asset, 5, and then you pay the taxes in here. Proceed from sale of old asset, the 2,000, and you're gonna tax on the sale of old asset is 8. Okay. All right, then they say changes in new net working capital. You need, that's what you need. On the fourth year, you need the working capital. 3. Terminal net cash flow is 4.8. How did they get it? Add them all and minus these 2. Because these 5,000 you're gonna receive it, cash inflow. Tax, you have to pay the taxes, $2,000 taxes, minus proceed from sale of old asset. So when you'll be selling your old assets, this will be negative. And tax on sale of old asset is 0.8. Now the question is why these two is opposite sign. Okay, this one I understand this system. So why question proceeds from sale of old asset? Look, the point is this. If you have the new bulldozer, okay, you do not have the old one. Which means you would have made, that's the question here. You would have made a proceed from sale of old asset. That's the opportunity you are losing. That's why it's minus. You are losing these two opportunities because you decided to go with the new bulldozer. That's why you have this two negative sign, or my opposite sign. Okay, tax saving. So you will be actually tax saving should be 0.8, but that you cannot get even this time. Okay, that's what they mean here. Okay, the terminal cash flow will be 4.8. So now, so last year's cash flow will be 4.8. So look at this here now. 18.8 is your incremental net cash flow. So you have to now add up this figure, this one, incremental operating cash flow, this one, with this one. That's it. So first is year 1, year 0, minus 44.2, where it is. Year 2, 12, 12, 14, but here 14, but you have to add last year's 4.8 needs to be added, it will be 18.8. So this is your incremental net cash flows for 4 years. Okay. All right, so here they actually explained you the how did they calculate these things. Okay, so yes. So here tax savings is 40% into $2,000 of depreciation, so which is $4,800, which is 0.8, the tax savings. Now, capital budgeting, now we're going to talk about capital budgeting method. So what we learned here, before I go with the capital budgeting method, because this one I want to go to the next page, so I will show you here. Now I'm going to have a very quick recap in here. From this one, firstly, look what we have done here. Introduction, what we have done with the 4 points, four distinctions, 4 points in here about different types of capital budgeting. It could be conventional, not conventional. Conventional means that conventional means you just cash outflow on the first year, other years cash just inflowing. But non-conventional means not necessarily that only the first year will be the cash outflow. It could be other years can be cash outflow too. That non-conventional. Okay. Then here this says if the cash inflows are every year same inflow, then this is called annuity. If it is every year is not same, it is called mixed stream. Okay, so and this one is easy one. It could be for what are the various purposes of capital budgeting. It could be for firms' activities, replacement of existing assets, taking new project, extension of the business. It depends. So, and here is come a mutual exclusive, independent or not independent. Independent, when it's independent, you can go for independent way. Like if projects are independent, the decision to invest in one of them does not rule out consideration of investment in another project. So if the project is independent, that means mutually exclusive. Okay, independent. So they say that the group of possible investment projects could be independent or mutually exclusive. Independent means they have no connection with one another. Mutually exclusive means you can take one, but you cannot take another one. Okay, one this or that. That's mutually exclusive. Okay. So if you go for mutually exclusive, you can take only one project, not more than one. But if it's independent, it will have to be. If independent, then it will have to be you no connection with each any of the projects. So you can go any project you want. Okay. So even you can go for more than one. That's all right. But mutually exclusive means if you go this, you cannot go the other one. That's mutually exclusive. Okay. And then you're talking about determine a project relevant cash flow. How you calculate project relevant cash flow calculated? So 3 steps: initial investment, and we have given you initial investment, annual operating cash flow, and terminal cash flow. Terminal cash flow is the last year's cash flow. Initial investment, annual cash inflow, outflow, net cash flow, and the terminal one. Then we have given you 2 examples in here. The short example, this is given a short example very briefly, and here is a detailed example is given in here. And that's the thing is first part. Okay, second part is this, that what are the various methods of capital budgeting? This is capital budgeting method. So there are 3 methods we're going to talk in here. One method is called payback period method. Here is one payback period method we're going to talk about. Then we will talk about net present value method. Here is net present value method, another method in here. Next page here. Oh. So another method in here. Net present value method. 2 method, and last method is called internal rate of return. 3 methods. Okay, 3 methods we'll be discussing. After we finish these 3 methods, then I will take you guys to our exercise today. We have around a lot of exercise in here, actually, to be honest. This is a very big one. Okay, but today we'll be talking only 7 of them, maybe 7 examples we'll talk today. But other examples we'll be talking next week. Okay, these will be talking next week. These we will talk only. Okay. So please discuss some of the problems from this week in the next week, because next week there is fewer problems. So this week we'll do 7. Next week we'll do a little bit more from this week. Okay, that's fine. So let's move on. All right, let's go in here. What does payback period mean? Well, payback period means here. I think I'll take it to the next page. So all of them are in one page. That's better. Now you can see 1 page for 1 method. That's nice. What is payback period? Payback period means that payback period means that within how many years your initial investment will be paid back. Within how many years your initial investment will be paid back. Okay, that is called payback period. Okay. So now this says here the first year is in here. Example they have given you here. Okay. Two projects we have, project A and project B. Okay. 2 projects we have in here. So year 0 is $70,000. I think 70,000. I'll say assume 1,000. So here project 1 is $70,000. Project 2 is project B is also $70,000. So first year project we get actually project A we get 10. Second year project B 30. Second year project A is 20, but second year project B is 15. Third year project A is 40, but project B is 30. Fourth year 30, 10. So you see that it's not same. It's not same. Both projects is not same. Also, Both, this is not annuity either, because they are not the same. It's not the same income stream for every year. It's like this situation. Okay, let's go on now. So $70,000 we need to recover. Within how many years we can recover for project A? 10 plus 20, 30 plus 40. By 3 years time, in third year time, we will see that it's done. Third year time. Within third year, we can get our 70,000 back. Very straightforward and simple. Simplest method is this one. Then if you talk about project B, in project B, you can see here, 70,000 is your first year investment. So first year you will get 30. Second year you will get 15. So 30 plus 15, 45. And third year, you're getting 30. We don't need 30. How much more we need? So 45, 70 minus 45, 25 more we need. But you're gonna get 30. So it means we do not need the whole 3 year. We don't need the whole third year, the whole 12 month of third year. So how are we gonna calculate it? We're gonna calculate that, let's say 30 of them we are getting by how many years? How many? 12 months, right? So we will say 25 divided by 30. Why 25 divided by 30? Because we need 25 here. Let's go back in here. See, that's what they have calculated. You know, the payback period for project A is 3 years, found by accumulating inflows. Payback period for project B, 2 plus 25 by 30. If 30,000 is returned by 1 year, how much it will take to return 25? Simple. 25 by 30. Okay, easy. And also I can show you, it's very easy, but if any of you want to get confused how the why 25 and 30 like this, so you can say like this in here. Let's say 30,000 cash flow in 1 year, in 1 year, right? Then you write 1 cash flow, $1 cash flow in, how much it will be? 1 divided by 30. Then you write here, so $25,000 cash flow in, how much it will be? 25 multiplied by, okay, multiplied by bracket 1 divided by, so which means 25 by 30. 25 by, that's how you got this figure, okay? So 25, so 2 year plus 25 by 30, which means 5 by 6. 5 by 6, it means like 10 months, okay? 10 months time. So payback period is that easy, simple, okay? So according to this, which project is good project? Project B is good. Why? It's better to collect the money as soon as possible for business. Simple. If you invest in one project, will you wait to get the money? How long you gonna wait? You don't want to wait. You want to get the money as soon as possible. Okay. So yes, so project B is a good project according to payback period. Now let's talk about net present value. Net present value actually tells you that you will be receiving how much this is here. 10, 20, 40, 30, 10. Okay. So you will be actually here calculate the present values. Okay, you're calculating the present values. Okay. So how do they do these things? They do these things in this way. Look, how much, okay, before I go ahead with these things, let me tell you the system, how we calculate it, okay? So they say this method is based on a consideration of discounted cash flow. Why discounted cash flow? Because all this money that we have listed here, in here, for next future 5 years. But we are making the project today. And our calculation is right now today. So we will be actually converting all these future cash flows in today's value, present value. The present value of this $10,000, how much will be present value of this future $10,000, how much today? Okay. What is the value? What is the present value of future $10,000 after 1 year? What is the, so all of this item we'll have to calculate back and bring the value on today, not the future value we want to calculate. Okay. So that's what they're gonna do. So yes. Here, what is the formula for present value formula? Present value formula is cash flow divided by 1 plus I to the power n. Where it is. Yeah. Cash flow divided by 1 plus R. Interest rate to the power n. N means number of years. If, yeah, so you add all of these cash flows. Okay, add all of these cash flows. We go in here. So year 1, 10 is cash flow 10 divided by, how did they calculate it? You know how did they calculate these things, right? 1.1. I know how they calculated this. It will be like actually 1 plus. Okay, let's actually copy this part. We can do it this way, I show you. Year 0, your investment is how much? Minus 70. Oh, minus 70. Okay, that's your cash outflow. Plus, this is the thing is coming up every year, so don't worry about this. Minus at the end here. That's already been attached there. 70. First year, you look at here, 1 plus 10%. You see, suppose R equal to 0.1, 10%. 0.1, and you see here to the power n. That's how they calculate it. And all these things are to the power 1. Second year, same. 1 plus 0.1 to the power 2. So it means 1.1 to the power 1. That's how they mean. So I will show you the breakup, how did they do it, just for you to understand better. Nothing else. Okay. So this is year 0, year 1, year 2, year 3, year 4, year 5. So when you see minus 70 is at the end, don't think this is year 7 coming up. No, it's not. It's actually year 0 at the beginning. Okay, I just want to clarify these things. Don't get confused on that. Okay. Yeah. Is it clear to you guys? Yeah? Is it all clear? You guys have any questions for me?
No.
Okay, good.
Not at the moment.
Not at the moment. Okay, cool. So this is the situation we have in here. Okay. So the answer came up, net present value came up as 12.37. The rule is if your net present value is greater than 0, you take the project. If your net present value is greater than 0, you take the project. If your net present value is not greater than 0 or it is negative, you do not take the project. Okay. So second project, project B. Second project, exactly the same thing. But second, you see minus 70 at the end, this actually you understand these things, right? By minus 70 I keep in the beginning and they keep at the end. It's the same thing. It means 70, since this is not divided by any other discounted factor, it means 70 is actually this year, current year. So here the answer came as 11.46. Which project you will take? Project A, because this gives you better net present value. Okay, you can take both the project, but project A is better.
It has more return, more present value, higher present net present value. Now, if you notice here, when you took payback period, that time we preferred actually project B. But if you take about net present value method, you prefer actually project A. See? Prefer project A. Okay? That's it. The last one is internal rate of return. Internal rate of return says that, like here, we calculated here like 10% rate. Okay? 10% rate of return. So now, if it happens that, now think this way. How much in here? 10 plus, I wish I could actually write down the figures in here. It will take a little bit time, but I don't know whether I should use the time for this or I should proceed. Okay, I'll do the other way around. Look, let's think this way. That your initial investment is 70. Okay. Now, the point is this. If at 10% discount rate, you get this present value. You will, it is 12.87. It means actually, I should actually write it down here. Is this 82.37 minus 70 equal to, this is the case. So all these figures, look at here, from here to till here, 5 years time, this is actually equal to our, this is actually equal to our 82.37. At what percentage? At 10% rate. Okay. Now the question is, very simple question. Simple question is this: at what percentage? Now I'm twisting. I'm twisting. Be careful. Listen to me very carefully. I'm twisting it. Now, if I say this way, at what percentage? Okay. At what percentage? What rate in this R? This R, 10% is in this R. At what rate? At what rate net present value will be 0? It's not 12.37. It will be 82.37. It will be also 70. At what rate? This rate is our internal rate of return. Okay. What rate we should use here? Then we will get 82. We will not get 82.37. We will get exactly 70. Our investment equal to our investment. That is our internal rate of return. So this says here. Internal rate of return is the interest or discount rate that equates the present value of expected cash flows to the initial investment. So all your expected cash flows are in here. Look, 10 present value of this one. Remember this present values of your cash inflows. Okay, it means that if you add up all these cash inflows, present value of all these cash inflows, it will have to be equal to the initial investment, 70. Okay, that's the question. So we want to find out that interest rate. That interest rate is your internal rate of interest. Okay, thus IRR is such that here you go. You see that? Or you can say this is equal to your initial investment. Okay, so this says here, here you go. Net present value equal to 0, which means your net present value of all your future cash inflow is equal to your initial cash outflow. See, CF, cash flow outflow of year 0, it means present today. Equal to the says here. Now the same here. All this future present value of future cash inflow will be equal to your initial investment. So how much? What is the rate? How do you calculate this IRR? It's not that easy to calculate because it's inside. You see that? It's inside. That's the problem. The IRR rules state that if IRR is greater than R, if IRR is greater than your cost of capital, required rate of interest, Okay, it means that you go for the projects. Okay, project is acceptable project. Okay, the project is acceptable. So this says if IRR is equal to net present value, if IRR equal to R, it says here, if IRR internal rate of return is equal to your required rate of return, net present value equal to 0. Okay, that's fine. You cannot say I will go, you cannot say I will not go. But if IRR is greater than your required rate of return, project is accepted. If IRR is less than required rate of return, no, the project is not accepted. So this is the rule. How do we calculate IRR? That's what we're going to learn now. In Excel format, how do you calculate them? So you can go through the steps. In Excel, the IRR for a project can be calculated by entering the relevant incremental cash flows one after the other in column, the net outflow and the negative values. In an empty cell, typing the following. So in Excel, you actually, so you add up all your cash flows. Then in Excel, there is an option, like IRR. Then you select all those columns in there, IRR. Okay, as enter, yes, then press enter. That's it. So it will be calculated by the Excel. Also, you can do it by scientific calculator. Okay, let's try it. Let's go to Excel. Yeah. I have Excel downloaded in here. So here is the project there. Okay. And here you write equal to IRR. Okay, IRR. 16.25. Okay, for project A. Let's bring the other one. Sixteen 16.85. Okay, now if you take in percentage, right here. Yeah, in Excel we have these things already. Now going back. So one is saying for project A 16.2. Actually, we gave you more accuracy, 16.250, and project B 16.855. Actually, take 4 decimal. Okay, 16.8555. Okay. Yeah, 16.9. So yeah, that's it. Okay. All right. So now another project in here. So this says here, year 0, 1, 2, 3, expected net cash flow is minus 50. And yeah, 20, 10, and 40, three of them. What is the net present value of the project? You know what? We can do the net present value too in Excel, I believe. But anyway, you know how to do these things, okay? 20 divided by 1 plus, and what is the rate? Is the rate 15%? Did you say the rate? Okay, R is 15%, they say it here. Here you go. Why is so small? Oh, because it's an equation. So R is actually 0.15% per annum. So 15% rate first year is here again minus 50 at the end for the initial investment. So 20 divided by 1 plus 15%, 0.5. This that's because it's 1.25 NPV. What is the IRR? Isn't 50 minus? Minus. So here you calculate these things. Yeah. Wow. Well, so now if you go in here, is equal if you write IRR, what is IRR rate? So choose this 2 years, 16%, percentage, 16.323 is IRR. And net present value, this one will be equal to NPV, net present value. We have to give the rate first. Okay, rate is actually 0.15. The question is, should I put it in decimal or in percentage? Anyway, let's see, 1.09. Okay, so yes, not currency, we want this number. It's 1.09. It's 1.25. Present value. No, it should be on decimal. Maybe some rounding figure, rounding error will be there, might be. Okay. It could be for rounding error because when we calculate in here, it calculates in here, it will be different. But every item will have different figures. But anyway, you guys know how to calculate these things now. So it will be 20 divided 1.05, 10 divided 1 square, mean square. Okay. Yeah, that's the whole thing. Nothing else in there. That's it, no trick in there. So where is the question actually? IRR for the project. Here is our IRR. So here is our IRR, and you can see here, question number B. So every year 20 by this. So you're calculating about using 16% rate. We are calculating 17% rate. Okay. What happens in this? We are using here trial and error method. We're using trial and error method in here. We are trying once. Let's say 15%. So we understand it will be either 14, 15, 16 like this. So we'll keep using it. Keep using different rates. Equal trial and error method we used here. We will calculating it actually different interest rate and see where we get stuck, where we find the zero. Now, so you can see here that if we take R equal to 16%, it becomes 0.299 this. If we take 17%, it becomes this. So this says that it's not clear that IRR will be within 16 or 17%. Okay, so this is trial and error method actually, to be honest. Okay, yeah, that's how they calculated here. This 16.323446. Look at here, 16.320. That's the percentage using Excel method. Anyway, another project in here. It's the same thing, same question again and again. Let's move on. What else we have after anything after this IRR? Okay. Now let's do these ones. Here this says that that's one value. Complex system has an outstanding issue of $1,000. Okay, this is what was the saying here. Complex. This is that complex system has an outstanding issue of $1,000 per value bonds within 12% coupon interest rate. So coupon rate is 12%. This issue pays interest annually and has 16 years remaining to its maturity date. 16 years of maturity rate remaining. Okay. If the bond, okay, the issue pays interest annually and has 6 years. If the bond of similar risk are currently earning 10% rate of return, it means market rate is 10%. Okay, or yield to maturity rate 10%. How much should the complex system bond sell today? Okay, so what will be the, how are you gonna do this? So we have to calculate it using, I have the answer here, but okay. So the answer is this. So here our maturity bond maturity value, how much maturity value? Maturity value is $1,000. What's the time? 8 o'clock. Okay, I will not actually keep typing these things, formulas again and again and waste our time. But I will do only one question. I will do now. Okay, I'll type the question for only one question. I will do for equations, and rest I will not. It's the same equation again and again. Okay, so actually, what's the point of typing? Let's go this one. Okay, instead of okay. All right, let's do it this way. So this is our formula actually. This is our formula, and the formula B0 is your bond value of bond. Okay, value of bond. That means what price you're gonna sell the value. Okay, is equal to value of bond is equal to what's the is equal to okay. If you go in here, 1 by m. It says here interest. How much coupon interest you are receiving? How much interest you are receiving from coupon divided by m, compounding in year. Number of compounding in year. If it is yearly, it's 1, m equal to 1. If it is half yearly, m equal to 2, like this. That compounding you mean, okay? After that, you put a bracket. Okay, a bracket. And we're gonna write here 1 minus, again another bracket, what it is, 1 plus, okay, required rate of return, RD. You see here, RD? What did you mention here? Required return, RD. Okay, plus, so you write it down, Okay. Required return divided by, again, compounding. Okay, compounding in here. How many compounds you are having? Okay, to the power, so you go in here, this one, to the power minus m into n, or here they said n minus n into m, same thing, number of years, we write down here, years to maturity multiplied by compounding. This is the way. Okay, that's the formula. And in down, it will be only this part. And down, we can return by compounding. Then you write here and here plus other part. Maturity values, maturity value, okay, divided by this. That's the formula. Okay, we got it how? Value, this is the formula we have. And bond value will come up as 1156. Guys, one thing you need to remember here. If it, now, how do you calculate interest rate? Coupon, interest of coupon? You calculate interest of coupon, you calculate it with this. See? 12% coupon rate into $1,000 maturity. So 12% of 1,000, 120. That's how we calculate it. You got this 120. One is from the formula, nothing to do with you. Okay, this one is from formula, this one and this one. Our required rate, we know, is about how much it says. They say required rate is about 10%. And compounding yearly once. It's yearly, so it's 1. Okay. And how many years is left to maturity? 16 years to maturity. Into the power 16. Okay. And how much the value will be when matured? Value will be 1,000 per value. Divided by again the same thing. That's how you get 1156 per second. So remember one thing in here, if it happens, the market value, required return, and the coupon rate. The coupon rate is 12%. So it means that entity is the issuer, the bond issuer. They're actually giving you more interest, more coupon, more interest than the market rate or the required rate. It means to adjust these things, you will have to pay them more. It means you'll be selling, they will be at this moment. If you want to buy that bond, you have to buy at a premium. That is 1156. If the market is paying more, but the company is the issuer or the company, the bond, corporate bond, if it is corporate bond, the issuer is actually offering a less coupon rate, that time the company have to give it the bonds to you at a lower rate, which means discount rate. Okay, guys? Any question for me so far? Any question, guys, now? Okay, let's move. Question number B. So describe the two possible reasons why similar risk bonds are currently earning a return below the cost. So why similar type, like market rate? So why other companies are actually offering different rates? And why complex companies offering more interest rate? Okay, well, the first one I will say that the company might, okay, look, interest rate changes within the time. Now, when they actually offered the bond, from that time, the interest rate might have changed. And second thing is this, that they're offering high interest rate, maybe the company is riskier, the bond may be risky. The beta is maybe less than 1, risky bond. Okay, that could be another reason. These are the two reasons in here. And number C, if the required, number C said, if the required return at 12% interest of, return is 12%, is 10%. Now this says that if the required return is 12% and the coupon rate also 12%, okay, then what will be their purchase price now? It will be the same 1,000 because both of them are same. Interest rate, required rate 12%, coupon rate is also 12%. Okay, that's it. It will be the same 1,000 will remain the one bond value and maturity value will be the same then. That's it. Now, question number 2, same thing comes up. Marigold's broker shown her 2 bonds. Okay, each has maturity of 5 years, a par value of 1,000, and the yield to maturity of 12%. Bond A has a coupon interest rate of 6% paid annually. Bond B has a coupon interest of 14% paid annually. So one is 6%, one is 14%. Okay, and yield to maturity is 5 years maturity. So you have N is 5. Par value is maturity value is $1,000. Okay, and market value yield to maturity market required rate is at 12%. This is actually the coupon rate is 14. So yield to maturity or the required rate is how much? 12%. And she got 2 bonds. One is offering at 6%, another offering at 15%. Collect the selling price for each of the bond. Okay, calculate the selling prices of the bond. So again, same formula, same thing, same rule applies. How much is first you have to calculate the interest, I, the interest rate, how much interest it will be. So they're offering, what is the rate? They have 6% annually. Okay, 6% into 1,060. For bond B, 14% into 1,000, 140. Okay, look at here. So bond A, 60, bond B, 140. M equal to 1 because both of them are actually paid annually. So M equal to 1. So M equal to 1. 1 minus 1 plus required rate for bond A. How much required rate for both the bond is 12%, market rate, 12%. 12. Number of years left, 5 years. 5. That's it. Plus, here is the maturity one. Maturity will be 1 plus 0.783. So now you see, notice something here, very interesting thing you notice. Market rate is actually, how much is market rate? Market rate is yield to maturity, the required rate is 12%. One of our bond is paying, one of the bond, which is 6% less, coupon rate is less than the yield to maturity rate, or the required rate, required return rate. Okay, so she's offering less interest rate. So the bond will be sold at now the bond need to be sold at a discount. So look, it's not 1,000, it's 783. And for this one, bond B, 14%. So this 14% is actually higher than the required rate of 12%. Okay, so it means who is going to buy the share, buy this bond now, they have to pay more than 1,000, more than par value, which is, now see here, 1,072 means they're selling at a premium rate. All right. Oh, is there any question left? 3. B. Assume that Mary will reinvest the interest payment as they are paid at the end of each year. So she'll be reinvesting the money. And that her rate of return on the reinvestment is only 10% for each bond. Calculate the value of the principal payment plus the value of the Mary reinvestment account at the end of 5 years. Okay, after 5 years, what will be there? She's going to reinvest the money. What the investment value is. So at the end of 5 years, okay. At the end of 5 years, both bond mature and will sell at par for $1,000. So after 1 year, the value of the bond is $1,000 is the value of the bond. So future value for A, bond A, we call future value now. Interest into 1 plus I to the power n minus 1. That's the formula again. The formula coming up in here. Okay. And here is 1,000 not discounted. Why not discounted? Because it's the existing year. That's actually existing year. Fifth year is your existing year at that time. That's why. Okay. So yes. So she'll be receiving actually 1,366 for bond A, 1,854 for bond B. And after 5 years, that will be the value of the bond. All right, let's move on. Number 3. Again, current market price of the bond, same thing. M is given, N is given. Oh, M is 2. Here in this case, M is 2. M is 2 means compounding now. M is 2. So here, I divided by 2. Look, all the M is 2. See? Same. Okay. These two is actually from your previous week lecture. I'll show you week 5. I showed the other instance. So this is from here, dividend payment. Dividend stream. Yeah, dividend stream. The price of your share will be the dividend, discounted dividend, discounted rate, present value of the future dividend inflows. The expected dividend at the end of period is the how much dividend they're gonna pay, they're gonna receive after 1 year, how much dividend they're gonna receive after 2 years, D2, and like this. And it will be discounted back to the present value. Okay. So now if I go back in here, okay. So the actual this is here. If the dividend yield for year 1 is expected to be 5% based on the current price of 20%. The current price is how much of the share? $25 current price. Okay, fine. What will the year 4 dividend be? Okay. What will be the year 4 dividend be if the dividend grow at a constant 6% rate they grow? Okay. So answer is year 1, 5% of 25, 1.25. That's the dividend. Okay. So year 4 is this. The 4th year. So 5th year, start of 5th year is the end of 4th year. Okay, end of 4th year is the start of 5th year. So they calculate dividend for the 4th year in here, 1.5 down. Okay. Here they calculate the return or dividend plus change of price. This is silly one, number 4. They have given you the dividend. The stock paying $5 in annual dividend sales of $80. So now, so stock paying $7 in annual dividend. So annual dividend is $5. Dividend is getting $5, and in annual dividend sales now for $80. Now you're selling this item for $80. You're selling the share for $80. Current today's price has an expected return of 14%. 14% is the return. What might investors expect to pay for the stock 1 year from now? So from now, 1 year from today. Okay, how much they're gonna pay? So you have to now calculate here the price of this item next year, which is your P1. And this year is P0, which is 80. P0 is your 80. P0 is selling it at $80. Plus the dividend is $5. Actual return is 14%. So P1 is. It's just the same. It's just the formula. Just enter the numbers and plug and play. It's nothing, no trick involved in here actually. Okay. This one is actually how much should you pay for a share or a stock that offers a constant growth rate of 10%, requires 16% rate of return. Is expected to sell $50 1 year from now. There's constant growth rate. This is another formula they have here. So if you go back in here, constant growth rate, share valuation, zero dividend growth, there is constant growth, constant growth, constant dividend growth with Gordon model. That's commonly used. Okay. So this is the one. And they're asking you to do it for how many years? Yeah. So here you go. the Gordon model. Pz equal to D1 divided by Rs minus G. That's your formula. Okay. Yeah. D1 is D1 divided by R minus C. Yeah. So R is equal to your rate of return, 16. Growth rate is 10% growth rate. Okay. 16 minus 10%. So D1 divided by D1 equal to 0.6 into P0. How you calculate the D1? So 0.06 into P0 price 0. You plug and play. Expected return will be D1 plus, so this is your formula. We know our D1 is 0.06. Into P0 plus P1 minus P2 by P0. So we actually separated them. This is the thing is for the dividend. So this part is for the dividend, and this part is for the price increase, incremental price, two different parts. We added up. Okay. So from there they calculate the P0 figure here. Okay. The expected return is 16. So yeah, just calculate the figure. One, well, that's to one item is not known. Easy. Okay, this is another one in here. Oh, just okay. All right. Okay. The gentleman who could not get his attendance today, can you please send me an email on this email address? Why I do that? I'm doing this because I will send your email, forwarded email, or make a list of the students whose name is not listed in my class, but they have been transferred to my class, so that the admin can actually add your name on the student on my attendance list next week. Okay, so send me an email at this address, and I will talk to the office. Okay. Now I would like to I will take attendance first, then I will talk a little bit about your assignment. Okay. Here is our attendance in here. Thursday. No. I want to actually freeze it. Here, freeze pan. Okay. Now, so week 6 is off. We'll take week 7 here. Okay. So Daniel is here.
Yeah.
Thank you very much, Daniel. Then Hyung Ham Cho is here. No. Then this is Thomas. Thomas David. No. Lee Pyong Tao.
Yes.
Thank you very much, Lee. Gurlin Kaur.
Yes, sir.
Thank you very much, Gurlin. Oh, I missed Mitchell. Mitchell is here? Mitchell? No. Gurlin in here. Priscilla. Priscilla here? No. Bahi Imam? No. Well, Win Kuriakoze? No. Ihan Lee? No.
Yes, yes.
Yeah, okay, yes. Utik?
Oh, sorry, sir. It's not me. My name is Yu Hong Li, not Yi Han Li.
This is you? No.
No. Oh, sorry.
Not Utik. Venkatasai? Ananya Rizal? Ananya Rizal, no. Timothy Smith?
Yeah.
Yes?
Yep.
Okay. You can hardly hear you, Timothy. Okay, Shibam? No. Antoine Bu? No. Junkai Wang?
Yeah, I'm here.
Thank you, Junkai. Tuan Bak?
Yes.
Thank you, Tuan. Yu Heng Lin.
Yes.
Thank you, Yu Heng. Deng Aduk. Deng Aduk, no. That's it. How many students did I have? 1, 2, 3, 4, 5, 6, 7. 7 of us? I think I saw more. Did I miss any of you? Jacob is missed. Okay, 7, 8. That's fine. It's okay. I can see that. All good. Jacob, send me an email. Okay. Send me an email mentioning your name because I have to mention them that I received this. Anyway. All right. Now let's go back to our assignment a little bit. And they said you have to get the data from Yahoo Finance. So Yahoo Finance. Yahoo Finance, you go in here. And they ask you to actually get the data from here. So you will get the data. So any company you want to take, so you have to choose the company first. You have to choose the company first, then you have to get the data. All you can get, they say that you have to get the all odds. Let's just see the all odds. So here is all odds, you can see that. And you can go to historical data for all odds Australia. Historical data is in here. So if it is monthly data, so you have to choose the time period. It's a 1934 to say something like that. Here is the questions. So you have to go here, Yahoo Finance. On the right-hand side, enter symbol or type the name of the company. What do you mean by Ihanli EI? What do you mean by why? Can you clear the question, please? What is your question actually? Because this is your assignment, that's why. I don't understand why you ask me the question why. Can we talk, please?
Hanley is here. Attendant.
Oh, okay, you're talking about the attendance. Oh, okay. Do I have it? I closed it.
Image is here. Jihan.
Okay. So you have to take that, just to close this figure. So, and if any company, for example, okay, now let's say I'm going to check from the Apple computers, Maya, for example, Maya, M-O-I-E-R, Maya company, Maya Industries, Maya Holdings. I think this is the Maya Holdings, the Australian one. Maya Holdings, for example. No, this is the other click. M-O-I-E-R, Maya Australia. So this is Maya Holdings Limited. You can see this company Maya. You can go to the historical data. Click on historical data. You can get the historical data. This is the summary. This is the chart. Listen. Go to historical data in here, and you'll see the company history in here. So they want you to actually get all odds. Okay, they ask you to take all odds. If you go to all odds, then you see here all odds in here at the top. Australia all odds. You go to all odds in here. And you can check it here, historical data for all odds. And I believe they ask you to take yearly data. You have to choose a company from the list provided. There is a list of company. I have seen that already. To the Excel file. If you surname, okay, that's the thing you have to find out. I'll show you. Historical data frequency is monthly. Okay, frequency is monthly. Time period set date with YTD. Okay, till today. But we start from where? Set that range from January 2014. Okay, so get for January 2014. I'm gonna go back. I'll write it down straight. January 2014. That's it. To here till today. Done. So that's your date. And I want these things to get not daily, I want it monthly. Okay, apply. You get the data in here. 20. This is January or December 13. I don't need December 13. Okay. So 1st of January, I will say 31st of January. Yeah, apply. Now you see. Oh gosh. March? No. Oh, okay. This is actually other way around. 31st of January. Then apply. So January 2014. So till today, monthly data is here. Then you click on download. Download. Then click on download. It will be downloaded in Excel format. That's it. So I don't see any complications here, to be honest. Yeah. Here is the data figure. It's all odd data. All odd. So you don't need open, high, close this. They said you just need the all odd. Delete it. Volume, you don't need it. Delete it. And here is your date. So here is the date and that just a close. Just your all odd. Right down at the top here. All odds. That's it. Done. So I don't see any complications, to be honest, in here at all. Okay. Easy. And what else? Download data. It's already, it told you as you keep the date and the adjusted close. That's why I showed you adjustment close there. Your share price of selected firm. So you choose a company. I showed you for all hours. You guys can choose any company. Okay, it's no big deal. Okay. Anything else, guys? No?
No, thank you.
Okay. Thank you very much. I'll close the meeting then.
Yes.
Thank you very much for coming in. I'll see you guys on next week then.
See you.
And I'll upload the video on YouTube. Hopefully by tonight or tomorrow if I upload it.
Thank you.
Thank you.
Thank you very much, guys. You have a good weekend.
You too.
Bye.